Welcome to RealCast, the weekly roundup of the real asset markets. My name's Richard Betts, and I'm joined this week by Dan Innes, Nicole Dines, and Paul Strome. Dan, let's start with you. What have you been following this week?
We've been tracking all the major planning and development stories in the market, and ITV, the television company's former London studios, could be transformed as part of a near 1 million square feet office, retail, arts and culture development by owners Mitsubishi Estates with a co-developer Core. And they've revealed their plans for a redevelopment of the site called 72 Upper Ground. And it will be converted into a 26-story office building connected up to two other blocks. And the scheme will also feature 75,000 square feet of arts and culture in an innovation hub, as well as public terraces that look over the Thames River. But in total, it's over 900,000 square feet of office space, which is quite a headline in the current market. Elsewhere, we saw the Netherlands' largest pension service provider, APG. They brought in a new chief exec, Annette Mosman, and she'd actually been a member of the firm's exec board as a CFO and chief risk officer since 2018. It's the first time APG has appointed a woman, and they've actually said publicly that they've been looking for the most suitable candidate, but with a preference for a woman. Annette, she entered the pension sector only 3 years ago, but she does have extensive leadership experience in the finance sector in Holland. Back to UK and retail, the big talking point this week has been a business rates review for retailers, and in particular comments by Lord Wolfson. Now, he's the chief executive at Next, one of the UK's biggest retail chains. He's calling for a big review, and he's asking for high street retail store business rates to be slashed by 35%, and that unless the government sets rates at a level that's fair, that a huge number of additional stores are going to have to close unnecessarily. Wolfson specifically says that the current system was unfair to bricks and mortar retailers, and many of whom, of course, are struggling with the pandemic. And then on to the department store sector, not just specifically the headwinds they've been facing for a number of years, but also in some annual results that are now beginning to be released. The Weston family may need to pump some new money into Selfridges and several other of the department stores that are in their group. It's come out as part of a publicly available accounts filing by Shell Holdings Europe, their parent company. They own department store businesses that include Selfridges, Brown Thomas, Arnott's, De Beerkorf. Quite understandably, they've all been facing a huge drop in tourism as well as store closures, and they've been dealing with the end of previous sort of tax-free shopping breaks. And then lastly, Uniqlo owner Fast Retailing hit a major milestone really, because the company's value, which is defined by its share price, has actually reached 85 billion euros. And that's more than any other company that operates within the global clothing sector. That said, the company still remains behind both Inditex and Swedish company H&M in terms of its annual revenue. But bravo to Fast Retailing.
I noticed actually Stockton on Tees in the UK, and the question there is, what do you do when M&S, Debenhams and New Look are all gone from your shopping centre? And in this particular case, the plans from the council are to knock down the shopping centre and replace it with a riverside park. So just interesting to see how some of these kind of maybe more radical solutions are coming to the fore already. Nicole, what have you been watching?
Well, on this subject, there's an interesting solution being suggested by Westminster Council. We've spoken before about the plans for Oxford Street. It seems to now to lure shoppers back after the pandemic to the department stores and the shops. And the latest project is a Marble Arch Hill. It will be a 25-meter high artificial green mount. It would be a feature on the landscape, and people will have to pay a nominal fee to get the wonderful views of a Hyde Park in Mayfair. And they'll only 25 people at the time. They'll have to book online. It will only be up for 6 months, but it's meant to be a talking point and to lure people back. And interestingly, in these times of Brexit, it will be designed and built by a Dutch architecture firm. And on the subject of e-commerce, that's obviously been responsible for taking shoppers away from the high street as well as the pandemic, of course. There's an interesting rankings that came out this week by the United Nations Conference on Trade and Development, saying that online shopping globally is worth $4.4 trillion, and this is a figure before the pandemic, so it's it's probably gone substantially up since then. And Switzerland has overtaken the Netherlands as the country that has the number one position. So an astonishing 97% of people shop online. And the UK is fifth. It's gone down one place since 2019. But interestingly, the report says that Europe is by far the most advanced place for e-commerce. Over 70% of people regularly shop online, and 8 out of the 10 top countries in the world for e-commerce are in Europe. That obviously encourages investments in logistics and last mile logistics and so on.
Really interesting also to see how some of these sectors are developing. I noticed as well this week that Edifica had made their first care home acquisition in Ireland, and Stefan Gillen's the CEO just pointed out that Ireland provides an attractive investment opportunity because the care market is still very fragmented, and the rapidly aging population will lead to increasing demand for healthcare real estate. Just interesting to see how those kinds of deals are particularly beginning to happen now across Europe. And also I noticed that Bauinvest had put in 100 million focused on the Nordic markets, and again picking up on that trend of beds, sheds and meds. Paul, what have you been following?
Data centres have come into focus again this week. These have been generally regarded as a bit specialised and niche, perhaps because their location criteria are not as straightforward as the asset classes that everybody's more used to. But in the search for alternative investments, that's perhaps a bit of an advantage. And we're starting to hear more investors and developers that want to get into the data center property segment. Obviously, during the pandemic, the internet and online retailing has come into its own. People working from home during lockdown have been completely dependent on web connections. Internet penetration has increased rapidly in countries where it was behind the curve. So it's very timely that Cushman Wakefield has published its data center global market comparison. And according to Cushman's findings, London and Amsterdam are Europe's only representatives in the global top 10 data center markets. Northern Virginia, Chicago, and Sydney are at the top of that particular chart. Northern Virginia is number one because of its large market size, robust fibre, attractive incentives, low-cost power, and because it has the largest development pipeline. Europe's up and coming, though, and Athens, Stockholm, and Moscow and Vienna are included among the 10 global markets to watch. But it's a very interesting list that also includes Nairobi and Cape Town, Santiago, Kuala Lumpur, Abu Dhabi, and Chennai. Cushman's Data Center Advisory Group leader, Dave Fanning, said that the shift to cloud services is likely to continue, but some established markets are hampered by increasing land values, limited power availability, among other things. And that's helping to unlock these emerging locations, some of which will possibly attain primary market status in the future as a result. This week, the British Property Federation gave IPSX UK, which is billed as the world's first stock exchange for individual properties, a bit of a boost with an open letter to the industry. BPF Chief Executive Melanie Leach said that the Federation believes that IPSX is a significant development in the modernisation of the real estate capital markets. She pointed to characteristics like dividend and cost transparency and suitability for direct or self-invested personal pension investment as being some of the attractions. And in a separate letter, industry heavyweights such as Segro, Nuveen, Savills, Tishman Speyer and Argent have been publicly supportive, as have prominent property figures such as former Helical chairman Mike Slade, Segro's CEO David Sleeth, and IWG founder and CEO Mark Dixon. I spoke to IPSX this week. The IPSX spokesman said that there is a strong pipeline of issuers ready to come to the market, and there could well be announcements in the coming weeks. It'll be interesting because it's never been done anywhere before, and it will give investors the opportunity to obtain a stake in an individual building. It could provide an alternative to sale and leaseback for corporates. And it'll also mean access to decent sized assets, as it's unlikely to be practical with anything under £50 million value because of the initial and ongoing costs.
Yeah, it'd be interesting to see how that launch goes. Just one of a series, I think, of new kind of innovations coming to the market. Looking at that data center side, Paul, I also noticed that in an interview I had with Erica Olsen, Chief Investment Officer at AREAM, Erica mentioned that the Nordics is still very much seen as a kind of safe haven for capital, but also picked up on that data center side as a growing area, particularly in the Nordics. Thanks very much, Paul. Thank you, Nicole. Thank you, Dan. Thank you for joining us, and look forward to seeing you next week for our regular roundup of the week in real assets. Thank you.